Another day, another story. The stock market crash of 1929, also known as the Great Crash or Black Tuesday, was one of the most devastating events in the history of the United States and a major catalyst for the Great Depression, a severe worldwide economic downturn that lasted throughout the 1930s. The crash occurred on October 29, 1929, but its roots can be traced back to the preceding decade. Welcome to Tabo Eminent Channel. Background. During the 1920s, the United States experienced a period of tremendous economic growth and prosperity, known as the Roaring Twenties. Technological advancements, increased industrial production, and widespread consumer spending created an atmosphere of optimism and speculation. One area that witnessed significant speculation was the stock market. The boom of the 1920s, stock prices began to soar, and more people, including ordinary citizens, began investing in the market. As prices continued to rise, investors took on significant amounts of debt to buy even more stocks, hoping for further gains. The market became a symbol of wealth and success, attracting people from all walks of life, including those who had little knowledge or experience in investing. The role of margin trading. One significant factor contributing to the stock market crash was margin trading. Margin trading allowed investors to buy stocks with borrowed money, using only a small portion of their own funds as a down payment. While this amplified potential profits, it also increased the risk significantly. As long as stock prices were rising, investors could afford to repay their loans and make a profit. However, once stock prices began to fall, these margin traders faced financial ruin. Signs of trouble. By 1929, there were signs that the market was becoming overvalued and due for a correction. Some industry sectors were already showing signs of weakness, and corporate profits began to decline. Despite these warnings, many investors remained overly optimistic and continued to buy stocks, leading to further inflation of stock prices. The crash. On October 24, 1929, the market experienced a severe downturn, known as Black Thursday. On that day, the market lost nearly 11% of its value. Panicked investors tried to sell their shares to limit their losses, but there were few buyers, leading to a sharp decline in prices. The following Monday, October 28, 1929, dubbed Black Monday, the market experienced another significant drop. The final blow came on October 29, 1929, Black Tuesday, when a record 16.4 million shares were traded, and stock prices plummeted. Many investors lost everything, and the total value of the stock market dropped by $14 billion. Aftermath. The stock market crash of 1929 triggered a series of devastating events that led to the Great Depression. The crash wiped out billions of dollars in wealth, causing many businesses to fail, banks to collapse, and mass unemployment. The ensuing economic downturn lasted for over a decade, severely impacting people's livelihoods and leading to widespread poverty and suffering. In response to the economic crisis, President Franklin D. Roosevelt implemented various policies and initiatives, collectively known as the New Deal, to stimulate the economy and provide relief for those affected. It took the United States several years to recover from the Great Depression fully. The lessons learned from the stock market crash of 1929 led to the implementation of stricter financial regulations and oversight, with the goal of preventing a similar catastrophe in the future. The Roaring Twenties had been a time of unprecedented growth and prosperity for the United States. The nation's economy was flourishing, and the stock market seemed to be an ever-rising tide. Investors, emboldened by the soaring stock prices, saw the market as a surefire way to accumulate wealth quickly. The belief in perpetual economic growth became so ingrained that it was commonly thought the stock market could never go down. In the early 1920s, the Federal Reserve, the central banking system of the United States, pursued a policy of easy money and low interest rates to promote economic expansion. This strategy encouraged borrowing and speculative investments, further inflating the stock market bubble. As the 1920s progressed, a significant number of ordinary people began to invest in stocks. Brokers and banks enticed individuals from all walks of life to pour their savings into the market with promises of remarkable returns. This widespread participation in the stock market by inexperienced investors made the market increasingly vulnerable to any signs of trouble. However, beneath the facade of prosperity, there were growing concerns about the health of the economy. Despite these red flags, optimism and speculative fervor continued to fuel the stock market boom. In 1928, Republican Herbert Hoover was elected president on a platform of continued economic prosperity. His administration embraced the idea of a new era, perpetuating the belief that the country was entering a time of unparalleled prosperity and growth. However, by late 1929, there were undeniable signs of trouble in the economy. Industrial production was slowing, and consumer spending began to wane. Some experienced investors recognized the overheated market and started selling their stocks, adding to the downward pressure. News about these sales created anxiety among other investors, leading to a sense of panic. The actual trigger for the crash is often attributed to a series of events in late October 1929. On October 24, a group of financiers, including prominent figures like Bernard Baruch, tried to stabilize the market by buying up shares of blue-chip companies. Although this move temporarily stemmed the tide, the underlying issues persisted. On Black Monday, October 28, the market suffered another severe decline, and the losses continued into the following day, Black Tuesday. The dramatic decrease in stock prices wiped out fortunes and savings, affecting not only individual investors but also businesses and banks that were heavily invested in the market. The aftermath of the crash was devastating. Businesses collapsed, and unemployment soared. People who had been affluent just a day before found themselves impoverished. The once confident and exuberant mood of the nation turned to despair and uncertainty. In response to the crisis, the U.S. government and the Federal Reserve implemented various measures to stabilize the economy. President Hoover signed the Emergency Banking Act in 1933, which aimed to restore public confidence in the banking system. Subsequent legislation, such as the Securities Act of 1933 and the Securities Exchange Act of 1934, sought to regulate the securities industry and restore trust in the financial markets. The stock market crash of 1929 serves as a powerful reminder of the dangers of speculation, excessive borrowing, and overconfidence in financial markets. The lessons learned from this event have since influenced financial regulation and the way governments respond to economic downturns. Thanks for watching. Request you to subscribe the channel.